And we are back. It's the moment 90% of the entrepreneurs have been waiting for. Our next panel is titled Venture Capital During a Pandemic and the State of Unicorns. Someone is repeating, a laptop is playing my voice in my ear, which is very distracting. Moderated by Zachary Sherman, an investor and strategist at Perig Ventures, featuring Gil Bader, the managing director at Comcast Ventures, also the founder of Gennacast, John Frankel, the founder of FF Venture Capital, and Mark Peter Davis, founder and VC at Interplay. On a side note, I met Gil Bader at Microsoft in a room full of 300 entrepreneurs, and Gil invited all of us to send him our pitch decks and said he'd read them and respond, which he did. So who knows, maybe he'll share his email again, or maybe he'll kill me for suggesting the idea. It's a real pleasure to have you guys here. Please, the floor is yours.
Great. Hello, everyone. My name is Zach Sherman, and I'll be moderating the discussion today about venture capital and the state of unicorns. A little bit about myself. I'm currently a senior associate at Perig Ventures. We're a New York and Tel Aviv-based venture fund investing in early-stage U.S. and Israeli companies focused on B2B data solutions that accelerate consumer-driven enterprises. We're backed by Nielsen and Tatcha Group as LPs, and we have a portfolio of amazing companies doing things with big data and machine learning in last mile logistics, on-demand consumer research, grocery retail competitive intelligence, and global meat monitoring. During this discussion, we're going to be covering an array of topics that entrepreneurs these days are dying to learn more about, especially given this new environment in which we've all been navigating. So all of you working at home or at the office or any other interesting place you may be working from, be prepared to learn a lot today, as we have 3 veteran VCs on the panel. All right, guys, so to start, I'll have you introduce yourself, telling us more about you, your firm, and your role. Gil, would you like to start us off?
Yeah, absolutely. So hi, everybody. I'm Gil Bader, Managing Director at Comcast Ventures and also Managing Partner and founder of Gennacast, which is Comcast Seed Fund. So Comcast Ventures, obviously, we're the venture arm of Comcast and NBC Universal. We're financially driven. So we look for great companies with great outcomes and align our interests there. We also, if possible, look for some connections with the mothership, but that's not necessary. So we're happy to open doors and make intros. Broadly, we invest in consumer and enterprise. I'm on the enterprise team, and we write checks, seed stage, 500K checks up to $10 to $20 million checks.
Awesome. John, you want to go next?
Good afternoon, everyone. John Frankel here, founder and principal at FF Venture Capital. We're a seed stage firm based in New York. We've been around since 2008, so we've seen the growth of the New York ecosystem. We invest across the country. We like to invest sort of $300,000 to $700,000 for 10% of a company. We follow on deeply until about a $50 million valuation, and then we stop. We have a focus of drones, robotics, fintech, and applied AI. And we currently have, I believe the count is 76 active portfolio companies. We're a highly engaged investor. And a lot of VCs talk about it, but when we look at the metrics, 50% of our seed-funded deals end up going on to raise a Series B, which is about 5 times the average in the industry. And so I think that's an indication that what we're doing is leading to higher survivorship and higher returns over time.
And Mark.
Hey everybody, Mark Peter Davis. Thanks for having me here. I'm the managing partner of Interplay Ventures. We are an innovation platform, so we have an early stage venture capital fund, which is the core focus. We primarily enter at the Series A investment point. We do a little bit of seed and some B, but A is kind of our sweet spot. We're generally taking a follower position in those rounds, co-investing with other great marquee firms. Very often we're identifying the deals we want to do, committing, and then helping to bring the syndicate together. We do B2B and B2C. And then what is a little bit different about Interplay is we've actually built out a robust operating platform. So we have 9 independent companies we've co-founded, which constitute a 400-person team that provides services to about 15% of all venture-backed companies in the US. We do things like commercial and health insurance, marketing, legal, accounting, tax, CFO, and many other things. And these collective services create a bit of synergy, which allow us to help the companies we invest in find talent, get introductions, and obviously provide them with advice on non-core functions or things that they have to deal with, which maybe they don't have experience with, such as tax, insurance, or otherwise. So that's us on Interplay, and excited to dig in.
Perfect. So let's jump into the first question. For the benefit of the audience, what is venture capital and what does it mean to secure venture funding? Who'd like to start us off?
I can lead off if you'd like. Venture capital is a very simple business. An entrepreneur comes to us. We give them hundreds of thousands or millions of dollars. They give us pieces of paper, a legal contract. And then 10 years later, they give us back a lot of money and we give them back the pieces of paper. It's that simple. Now, there's a little bit of detail in between because a lot of people who come to us who want money, we may not want to invest in. And so there's a filtering down. At our firm, we look at about 2,500 companies a year to filter down to the handful we want to invest in. And, you know, those are ones that are in line with our criteria and ones that speak to the partners personally. So they feel that they really want to spend the next 7 to 10 years working with a founder, helping them build their business. But that's fundamentally it. Not all businesses should raise venture capital. Certainly not all businesses that want to raise it end up raising it. But there's a lot of businesses where it doesn't make sense. But for a high growth, disruptive, in our case, technology-driven company at the seed stage, it fits within what we're looking to do.
Yeah, I'd say
I would 100% agree with that, John.
And once a company secures venture funding, how does that change the dynamic and how they operate?
So once they have the money, they then need to execute. And usually you raise enough money to last for 18 months or so. And hopefully over that period of time, there's enough execution that they can then go and raise a round at a higher valuation. Now, when they raise money, they're taking dilution, and people always, worry about the amount of dilution they take on the round. In reality, the dilution that happens between rounds is based on execution. If you execute very well, you'll raise money at a much higher valuation, you'll give up less to the company. So, and then you raise the next round and you're on all the way through along your journey.
I think it's also important to note that once you take on venture funding, you now have a partner in your business forever. And as John mentioned, it's not always the right thing for all businesses, and for some businesses, it's the right thing to do. But also, it puts you on a different path for your business. Many businesses can be very successful. They could get revenue, they can be profitable, and the founders of the company without venture investment can then take all those profits and they can buy a second home, a boat, an airplane, what have you, and have a nice lifestyle. Unfortunately, once you take venture money, that option it's almost off the table, because what we're looking to do once we invest in the company is looking to build the value and the value of the stock. And so at some point, somebody's going to, pay you money for that stock, whether that's you get acquired or whether you IPO in the rare case. And so just having profits, which may sound kind of odd, isn't enough necessarily for a venture-backed company. We're looking for a venture outcome, which is traditionally, somebody buys the company.
Right. So to add on to that, for entrepreneurs who can make a small business and have cash flow coming out, this is not a good fit. Venture capital is a much better fit if you're going to have a large outcome, and typically if you need a lot of capital to achieve it. It's the cross section of those two elements that generally put you in the strike zone for raising venture. And to Gil's point, which I think is very important, it's a little bit of golden handcuffs, right? If you take venture capital, there's a tremendous amount of upside, and companies that need venture capital should raise it. But you are committing, when you take a venture round, you're committing to a partner to reinvest basically all of the profits until you can achieve a very large outcome, which means you're foregoing short-term cash flows and payouts that you might have had along the way otherwise. So it's not appealing for lifestyle businesses and otherwise. I actually wrote a book on fundraising. It's called The Fundraising Rules, and there's a chapter dedicated to a 2x2 diagram for how to think about how you should finance your company. It's an interesting fact. When most people are asked what's going to make their company successful, they'll sit back and they'll tell you the team, the market size, product market fit. Very few will talk about how they're going to finance the entity itself. But that financing decision can materially change the outcome for the entrepreneur, for better or for worse, depending on how well aligned their strategy is, the business strategy, with how they finance it. You want to get those two things in sync. And when they're not in sync, it can destroy value for entrepreneurs.
Very good. I think that was a great overview of what entrepreneurs should expect when they approach VCs and what's expected from them. Now I'd like to talk more about the more recent deals you guys have completed in the last 6 or so months. How many deals have you guys done? And were they pre-COVID deals in the making, or did they come about in the midst of all this? And along the same lines, what are the new protocols and expectations entrepreneurs should be aware of regarding raising a round in this environment?
I'll chime in on this to start. I think John and Gil will have lots of great insight as well. I think the market changed drastically in March and April from our perspective. We saw material compression in valuations. No one knew what was going on, and so VCs were more reticent to invest. Since then, it feels as though the gears are churning again, and raising money is probably a little bit more difficult, but deals are happening and the market's moving. We've made 7 investments this year, which is pretty consistent with our normal pace. There is a pattern that happens in venture when there's a material downturn or recession, right? Well, when you look at private markets like venture, where you're investing in a company where the outcome might be 5, 6, 7, 8, 9 years away, typically people aren't thinking about how the public market changes can actually affect the venture capital market. But there's a factor called the denominator effect, where the limited partners upstream from us, the people who give the venture capital firms money, may find that if their hedge fund positions decline because the market's down, they're suddenly overweighted in venture. And it may reduce their willingness to invest in additional funds for John, myself, or Gil. And the net result is a lot of VCs will slow down their pace of investment. We're seeing some of that today, but it hasn't been as strong of an impact as we saw in 2008, where things drastically dried up very quickly and held that way for a little bit. I'll pause and let the other gentleman chime in. I think they'll have a great perspective.
For us, we sort of are in phase 3 post-COVID. I think for us, phase 1 was really triaging the portfolio, trying to understand the impact of COVID on our portfolio, which ones needed cash, which ones are going to be just fine, and which ones might be in serious, systemic trouble. And that probably took about a month or two. And then I think the next probably month or two was all about understanding what is the impact of COVID long-term on some of the sectors that we invest in, whether it's, enterprise IT or on the consumer side. And see, are there some fundamental shifts? And obviously there were in hospitality and travel and other industries. And so really trying to understand for the sectors that we invest in, what might be some long-term impact. And so now I mentioned, I think we're in phase 3 for us, which is portfolio has been secured. We think we understand, the longer-term impact. And then we're, in investing mode. Some of my partners have been investing throughout. whether it's doing follow-ons in portfolio companies or investing in new companies. But our diligence process has changed. It's difficult to meet entrepreneurs in person. And look, as John mentioned, we're tied at the hips for 7 to 10 years. And so we want to get to know these entrepreneurs as people, their personalities, want to make sure the chemistry is there, that we have formed that relationship between us. And that's difficult to do over video. And so we're end up having to spend more time on the phone, on video with them, maybe do a walk in the park if they're in the area, socially distanced. But we've also tripled down on reference checking. So whereas before maybe we would do 3 or 4 reference checks on an entrepreneur, now we're doing 10 and 12 checks. We're going deep into the bench to make sure that we get a good understanding of the entrepreneur before we invest.
These are all, great responses to this question. It comes up a lot. Fortunately, some time has gone by and we actually have some data. And, we like to make data-informed decisions. So I'll give some data and I'll give some anecdotes at the end. What have we seen? When we look at it, our companies in aggregate have raised up to the end of August, pretty much to the nearest $3 or $4 million, the same amount in aggregate. So capital, which we all worried would shut down, really didn't shut down. Now the price people were able to get might have had a liquidity discount in it, and companies that raised, particularly in April, May, and June, raised at lower valuations than they would have elsewise. But liquidity stayed there, and I think that surprised a lot of people in the community. The second thing that we look for is how are the companies doing? Now, on average, our portfolio did just fine. In Q2, which was probably the largest quarterly contraction in GDP any of us have seen and hopefully will ever see, our portfolio companies grew revenues 30% year over year. So, COVID being an accelerant for tech played out across our portfolio. Anecdotally, we spent a ton of time initially triage, trying to understand, see which companies were under duress, working hand in hand with our companies over PPP and other programs to help the weakest companies in the portfolio. And when they needed to apply, making sure that they completed the forms correctly and appropriately. And so we proactively tilted our time to looking after our existing portfolio. And that we think was the right allocation of time. We've made follow-on investments and we've invested in a new company since, but we purposely slowed down new investment. Why? Because whenever you have a recession or a downturn in the economy, it creates disruption, which enables new talent to surface as entrepreneurs. And whenever you get a behavioral change that comes out of that, you get new companies that are created against that behavioral change. What we saw this time was a massive behavioral change throughout society that we're still trying to get our heads around. I think, everyone around this table here, virtual table, another change. Everyone around this table here is trying to work out what their office life is going to look like post-COVID. Are they really going to go into the office 7 days a week? Are they going to fly out to every board meeting? Or are they going to use Zoom for some of them? Are they going to be more efficient with their time? Are they going to have different tool sets? And that's just in this narrow environment. But across the whole of society, there's a lot of change with regard to behavior. And then costs of starting a company have gone down. They've gone down and really because of a better efficient usage of tool sets, and the analog costs, if you're going to pay rent, is going to be less, and the like. So when you put that together, our expectation is 2021, 2022, we're going to see a crop of really interesting companies. And, you know, we still, throughout the downturn, we're looking at 50 plus companies every week. And I didn't see any amazing one. I mean, I did see one or two that were good, but, you know, nothing just sort of blew my socks off. And now we're starting to see entrepreneurs come to the market with business models that we think are orthogonal, are different. They're looking at the world differently. And that's getting us interested. So we deliberately spent our time on our existing companies. We slowed down deployment of capital unless something was just amazing. And we expect over the next couple of years, we're going to see some amazing companies come up by entrepreneurs incredibly talented that otherwise would have been very comfortable working for, you know, this large corporation or that large corporation.
And that's a pattern that I think we saw in 08. We saw a lot of great companies come out of the downturn. So to echo John's point, we're at a stage later than where John and FF invest. And so for us, we actually saw this transition period as a great opportunity. There's a group of companies that are counter COVID that we were seeing exorbitant, incredible growth rates to existing business models that already had strong fundamentals. We found those companies to be growing faster, the deals to be more accessible, and the valuations to be lower. So we took a contrarian view in this market and proactively chased those opportunities and deployed, I think, into 5 or 6 deals since the cycle changed. I do think that what happens in these periods, though, is there's a little bit of a shaking of the tree where average companies are less likely to get funded, but the best companies continue to receive capital. And so as there's a flight to quality, we try to participate in that. But all these different strategies do make sense. And there's different ways to approach it. We've been a little bit more aggressive in this environment from the sound of it than some of the other folks.
Thank you very much for these thoughtful responses. I'm not sure if we're having video issues or it's just on my end. If it's switching, do you guys see it not switching to whoever's speaking, or?
I see it switching. Oh, it was switching to whoever's speaking. I don't see that now.
Yeah, it switched it. I turned it back. I turned my view back from speaker view to multi-view or whatever. That's the way I like it.
We'll push through these technical issues and move on. But to go along with the last question, right now the persistent trend in VC that I've seen in recent data is, even over the last few years, more available capital being deployed, but into fewer deals, but much larger deals with a lot more strength at the later stages, and more so stagnation at the early seed, pre-seed stages. So post-COVID, will this trend continue? And do you think investors' expectations are going to change in terms of things like traction, revenue, and business models?
I think, as with any sort of financial downturn, there's a flight to quality. Certainly, there's more capital on the sidelines now than there ever has been in venture, and that capital needs to be deployed. And those companies that are doing well, that are high flyers, are getting, follow-on rounds, up rounds done. We saw that all through, May, June, and July. We were looking at a number of companies, series, B, A, B companies, and if there were strong companies getting good traction in choice industries, they were highly competitive deals, and valuations skyrocketed. As Mark mentioned, those average companies, a lot of those who went to market weren't happy, either took down rounds or decided maybe to do an inside round or take a bridge to get them through next year. So I think next year we're going to see a normalization of funding that will probably look more like last year than this year.
Zach, to the subtext of your question, there has been a macro trend over the last few decades of an increasing surplus of capital in the venture community. There is less of a shortage of capital than there was per se in the 90s. And that has shifted the balance of power in favor of the entrepreneur at the negotiating table. And it has led to a lot of companies that wouldn't have otherwise received capital to be funded. I think that the ultimate impact of that is it's going to dilute returns for investors who are less disciplined and don't filter companies with the proper diligence and don't have a viable strategic view. Yeah, I think that pattern is what you're seeing with your comment that there's a lot of early stage companies, seed companies that don't cross the chasm over to getting a Series A. And we're also seeing a different phenomenon now where there's a lot of capital at the later stage driving up valuations pre-IPO, which those valuations may or may not be sustained when the companies go public. So we are in a very different capital environment than I think the venture ecosystem has ever seen in its history. I think before the boom in the 90s, when venture was really popularized, there was a shortage of capital and entrepreneurs had to chase VCs. In the first decade of this century, there was a shift starting to happen, and then we saw VCs starting to market themselves, and suddenly every VC is a columnist on Twitter and blog posting and doing all the other sorts of marketing activities, whereas before they were invisible. And then we see a shift. We saw a shift at the around 2009, 2010, where venture firms became increasingly competitive in ways that could add value beyond capital. So all of those dimensions have driven greater competition. I think it's going to result in better economic output when you look at the overall innovation economy. But there's going to be a larger wasteland of companies that die after receiving funding who should never have been funded. And you're going to see a larger wasteland of investors who dumped money into overvalued companies towards the later end of this cycle and didn't really generate a great yield. We believe Series A, and I think seed and B have sufficient arguments of this as well, is an efficient risk reward profile. We like, when we look at companies, we believe we can see that they have the appropriate traction to understand that the company has good prospects, big upside, quantifiable operating and financial diligenceable KPIs that allow us to believe this is going to have a good outcome, but we're getting in early enough where the valuation still presents material upside, even if they don't get to the public outsized valuations or some of these unicorn rounds. So that's how we look at this. We take a very math-oriented approach to early stage investing, which is, I think, an unusual strategy. And it harkens back to my background. I spent a lot of years doing private equity M&A diligence, looking at fundamentals in companies that were not venture-backed. And we've married that into our early stage thinking to give a mathematical viewpoint on how we invest in early stage companies. But headline is, I agree with you. I think the landscape has changed around the capital side, and there's a new set of levers that are being pulled. Last thing I'll say, and then I'll shut up because I'm talking a little too much, is we're also seeing a more robust secondary economy. That market was not as critical back when companies could flip to going public within a 4-year cycle, pre-Sarbanes-Oxley. But in this world we're in now, where you've got companies that are very highly valued at the tail end of their cycle, it's unclear whether the public markets will support those companies as they try to rationalize the underlying business models. You're seeing a much richer secondary strategy. And it's something that I think early stage investors such as ourselves need to be thinking about when you make bets. And you've generated you put a good multiple up, you need to be thinking about liquidating and exiting even before the company has its own natural exit event. And that is something we actively do.
Thank you. I think this was great information. You mentioned what you were doing before VC, so I think it's a good segue into our next question. One of the questions I get all the time, most common question I get is, how do I get into venture capital? So, what is the application process or path to becoming an entrepreneur in resident with your firms? Do you only accept people who've taken companies public or have a great track record? And also, if I'm 25 or 35 or 45, what is my path to becoming a venture capitalist?
Well, let's start from a different perspective. Same question, different perspective. Why on earth do you want to become a venture capitalist? It is a tiny market. Venture, I mean, private equity is a small market. Venture is a small section of private equity. Within that, if you are a venture capitalist, you're not going to know if you're any good for 10, 20 years. You need time to make decisions, make those investments, and get those returns. So it's a really peculiar profession that you don't get any feedback in a given month, in a given quarter, in a given year, whether the decisions you made over that period actually were the right ones or not. You can have a company that is doing fantastic and then trips over its shoelaces on exit and you lose money. You can have a company that's a disaster that someone comes along and buys for a big premium. It is very difficult for people to know. And as folks know, venture capital returns have a wide dispersion, which means there are a lot of people in this industry who've been in it, multiple years and never even seen carry. They wouldn't know how to spell carry. And yet carry is the carrot, the incentive for them to stay there. So, when you look at it, I don't know, in my 20s, would have wanted to make a decade plus commitment into an industry where I wouldn't know if I was any good or not during that period? I strongly advise people to do this in the back half of their careers after they've built up some experience, confidence, maybe capital, connections. And then if you took everybody in New York in venture, you could fit them in a medium-sized conference room at Morgan Stanley or Goldman Sachs. It's really a very small industry. So let's start there. I see Mark wants to jump in.
Yeah, no, I had a mentor of mine, someone who brought me into the industry, gave me that speech, John, when I was thinking about it, trying to dissuade me from making the move. I think it's something either you're passionate about or you're not. And for me, I've always been invigorated by entrepreneurship and innovation. Gil's a serial entrepreneur, right? So for many of this is something we care greatly about. We think it has an impact on society. We think we can have a strong financial product for the LPs. But yes, there are some limitations to this career for sure. I do have a video on this on my blog for those who are interested. It's 30 minutes on talk on how to get into venture. The headline, I think, is you have to understand that Gil and John and I are under-resourced. We have relatively small teams relative to most companies and large organizations. So our hiring processes are generally inadequate. And when there's a moment where there's an opportunity to bring someone into the firm, we go out and do an interview cycle. But very often, while it's open to the public and people will apply, there are people who have taken the time to build the relationship ahead of time. And they've brought deals to us and they've been contributing and demonstrating that they have the skill set along the way. So that is my advice to folks, is to go ahead and get out ahead of the game, start building relationships by grabbing coffee and digital coffee in this era with VCs and building those, having those conversations before there's an opportunity. And then when the door opens, you want to be standing there. And that helps quite a bit.
Mark, when you put out a public job offering, how many responses do you get? 500
to 1,000 for one role. Yeah. And but when I came into venture, so I got my first internship in venture 14 years ago. I did not take John's advice. I started in my 20s. And when I started in venture, I stumbled into an internship that had been open. I don't think there was a process. I just met the right person the day after their intern quit. That was it. When I left that job, I'm pretty sure 500 more qualified people applied. So it is extremely competitive. And to John's point, there are some real challenges to the career path and the role if you're not good at it. If you're good at it, it's a great role. But sometimes it's hard to figure that out for quite a while. It does take
my path into, oops, sorry to interrupt.
Yeah, go ahead, Gil.
My path into venture, not uncommon, but a little bit different in that I had a technical background, was a founder, CTO of a couple of companies. When my last one exited, I had already been part of two startups and was very lucky. Still wanted to be involved in early stage companies, but didn't just want to be an advisor or sit on a board. I wanted to have some skin in the game. And the best way to do that is to actually put some skin in the game, to invest in these companies. So I formed Gennacast some 12 years ago to invest in early stage companies. I felt I had something beyond just capital to give, some experience, some mistakes that hopefully won't get repeated. But my advice to folks who want to get into venture is, I completely echo what Mark and John said. It's very difficult. Like, you don't find venture, venture finds you. And there are very few openings. You never hear about these openings. But my best advice is act like a VC with your own portfolio. Do what a VC does. Source companies, so find interesting companies, maybe invest 5,000 or 10,000, whatever you can afford in these companies. Add value, try to add value to these companies. As they get follow-on investments, your portfolio gets marked up. Maybe you can introduce those companies to some firms, venture firms who do follow-on investments in that company. Embed yourself in the ecosystem. Act like a VC. Source deals, diligence deals, do deals, add value to these deals, make intros to other to VCs. And that's how you'll get known. That's also, to John's point, how you can see how well you're doing. Are your portfolios getting follow-on investments? And then for someone who has no experience, formal experience in venture, if you go then to do an internship or look for a job, you can point to a little bit of a track record.
Great. I think we have less than 10 minutes, so I want to jump to the next question, moving to unicorns. So going forward, what is the state of unicorns? Are we going to see a massive correction in valuations? For example,
No.
This time last year, WeWork nosedived from a $47 billion valuation to $12 billion. That's one example, obviously. And in 2020, Lime, the scooter rental firm, valued at $2.4 billion, stopped its services in Europe and America because people were staying at home. Another example. Also, I thought, appropriate to add to this question is, how are SPACs playing into this equation?
Okay, let me take this. We're in the middle of a long boom that's going to be as long as most of people's careers here. And that long boom is just setting up the environment for technology companies to own the world. And so you will see a slow and steady continuing shift to technology. You've seen it in the public markets, you'll see it in the private markets. And so unicorns as a concept is not going away. Are there companies that are badly valued? Yes. Are there cyclical businesses that are being pitched as secular? Yes. In a zero rate environment, there will always be misallocation of capital. However, it is just easier to scale faster. You are finding that companies are getting to significant amounts of revenue, whatever the number is, $100 million, faster than they could have in the past, because of all of the layers of infrastructure they sit on top, whether it's AWS, Zoom, or whatever. These tools that we take for granted that have allowed us to go into lockdown. Could you imagine if this was 95 and the virus had come along? You couldn't just go and, work from home because you couldn't access your records. They're in paper records sitting in your office. To pay your bills, you'd have to get your checkbook, right? These layers of infrastructure are lubricating the growth and size of companies, and disruption we're seeing here will create another new wave. Now, SPACs, fascinating. Direct listings, fascinating. Prior to being in venture, I was at Goldman Sachs for 21 years, and the last 11 years on the sales and trading floor. I saw every single company Goldman took public. And in the mid-90s, we would take public companies that were raising 50 million, 75 million, 100 million, at valuations of 500 million, 800 million, and the like. That was very common. I think someone told me, and I haven't looked it up, but it should be very easy to look it up, that both Microsoft and Apple, when they went public, had market caps of a few hundred million. We have got rid of that whole space. You can't go public with a market cap of a few hundred million. And the reason is the Goldmans, the Merrills, the JP Morgans have got bigger. And for them to earn enough fees on an IPO, they want them to be bigger. So it's not economical to go through the bulge bracket banks and IPO unless you're going to be at a multi-billion valuation. SPACs and direct listings are allowing companies to get public earlier. I truly believe a company at a 500 million, 800 million valuation certainly should be able to go public. And SPACs and direct listings are allowing that to happen. And I hope that these tools continue to be deployed to do that. That, I think, is in the public interest. I think it creates a whole slew of interesting companies that the public want to follow. And I think it's an efficient allocation of capital, which is what the capital markets are all about. So, yeah, I'll stop there.
I think that's very well said. I want to echo what John was signaling on the unicorns. I think they're going to be around. I think not all unicorns are the same, is the key takeaway for me. There are companies that have fundamental underlying business models that justify those valuations and the expected future values. And there are companies that don't. You mentioned that WeWork. WeWork had the economics typically of a more of a real estate company, but was valued as a high growth tech company. And that's a misalignment. And those types of moments will happen. There's always euphoric investing. But if you find yourself investing with good managers, it's the responsibility of the VCs to avoid those situations and present LPs with better returns by sticking to the companies that have the underlying fundamentals. And there are plenty of them. So we're going to see a lot of enormous companies scaling faster than ever before, owning larger percentages of markets than ever before, because technology is eating the world.
Just, I know we're almost out of time, but two quick comments there on unicorns. There are too many legacy industries that are in need of disruption. So I think we're going to continue to see multi-billion-dollar companies, created, in the future. And second, on SPACs, I think we're going to see the pendulum swinging. It hasn't fully swung in the direction of, a SPAC a day. But I think we'll get there until the point where we start realizing that some of these companies are going public earlier in their maturation cycle, and thus are not ready for the Wall Street rigor and repeatability, scalability, et cetera, of their revenue and product streams. And then I think we'll probably see a pullback.
I just want to add one thing. Gil makes a great point. There's too many industries not disrupted. When we think of tech and these unicorns, people who are not in the tech industry are probably immediately thinking of social media, the things we're all touching and using. But there are a lot of outdated industries that are now being disrupted through tech. We're in a hardwood flooring play. And that's something no one's paying attention to. It's not sexy. We generally prefer not sexy industries when we invest. There's a lot of opportunity in those spaces to bring modern business practices and technology to build large companies.
So I think we're just about out of time. I think we have 2 minutes. I can add in one quick question. So this seems to be the popular ending question. Since this is the future of things to come, what is your price prediction for Bitcoin and when?
Okay, so I think it's like at 11 or 12,000 now. So I'm going to say that in 1 year it will be 14,650. Exactly.
We got 14,650. John, what are you going to bid?
Close, but without going over.
I really don't have a valuation on Bitcoin. Yeah, I'm waiting for there to be some functionality where blockchain is both necessary and sufficient to lead to an outcome that is 10 times better than other database solutions. We have been spending the better part of a decade with enormous amount of talent and money and energy trying to find that solution. I find it very frustrating we haven't had the Netscape moment. I truly believe there's enough momentum that this could carry on for another 10 years without there actually being any end use case other than, trading coins amongst each other, moving funds illicitly or moving funds cross border to get around government control. But for underlying usage, I just haven't seen it yet, and I find that very frustrating. So given that, the only way to price it is priced off of momentum and the greater fool theory, and I don't have any methodology for doing that.
You don't think there are some greater fools out there?
I haven't seen one. If anyone sees one, I'm on Twitter, John_Frankel. Please hit me up, and I'd be more than happy to review it. But we've been looking long and hard and haven't found anything.
Yeah, I would echo.
I would agree with that.
Sorry, Gail, go ahead.
Yeah, no, I would just say
we're a little bit over time. So, Mark, do you have a price prediction?
The smartest thing I've seen on pricing Bitcoin is a scarcity model, much like the difference between silver and gold. The rate of production is declining or release of Bitcoin. So if you follow that, it implies that prices are going to go up quite a bit. And there's people betting on that. So I'm going to go higher. I'm going to go 20K.
Amazing. So I want to say thanks to the panelists for their time. It was a pleasure to moderate for you guys. And thanks again for these amazing insights.